I want to start with you, Samir, because you cover kind of the global market. Based on Eunice's report and everything that we're seeing out of China, how concerned should we be about this data and the subsequent move to, in fact, ease over there?
Within emerging markets, you should be pretty worried. And, we've been unfavorable there for some time. And a lot of it can really be tied back to China, which is, the biggest weighting within emerging markets and, probably the big growth engine. And, maybe the part that goes left unsaid is they can't really ease and turn to what they've done in the past to foster growth because those developed market central banks are, increasing rates the way they are. They would, clearly lead to increasing capital flight and would make the system there even more fragile in China. So unfortunately for China and the emerging markets, the threats are only growing. So we would continue to avoid that area.
Jonathan, clearly having some spillover effect here in the U.S., even though markets have climbed their way up since opening back toward the flat line. Just broadly speaking with U.S. equity markets, it feels like we're kind of at this inflection point. We're almost done with summer. We're going to come back after Labor Day. Maybe people will be paying more attention. Who knows? You got Morgan Stanley on one side saying that they believe this kind of bear market rally is short-lived. J.P. Morgan believes the rally has room to run. Which camp are you in?
Well, I'm definitely in the J.P. Morgan camp, and I think that there's a silver lining in this bad news. Listen, nobody wants to see a major slowdown in China, but what the Fed is trying to do is to damage demand and bring down inflation. The reason the market has been up 17% in the last 8 weeks is because inflation expectations are falling, oil prices are falling, expectations of a slow in the economy to something which looks close to stall speed allows the Fed sometime, and this is, again, not my Credit Suisse call, but this is what consensus is that sometime around the first quarter, the Fed can stop their rate hike cycle, or at least pause it, and allow the momentum of this thing to go forward. That's what the futures market is telling you. So a slightly weaker data out of Europe, weaker data out of China is effectively doing the Fed's job here, which is it's slowing global demand. So yes, the market didn't like this, but 35 basis points down on news that China looks like a bit of this is really bad news. It's the market absorbing this incredibly well that there's an offsetting positive here.
So what does it say to you then overall for the market, particularly, of course, coming off of two tamer, perhaps, than expected inflation reports from last week?
I think what it says is that the environment that we've seen the last 8 weeks has legs. And the reason is that again, I believe this, but also this is what the market's saying is the odds of a soft landing are higher now than they were 2, 3, 4 months ago. Now, I'm not saying that we're going to have a soft landing, but the odds are increasing. That's what's driving the market up. And if you look at the nature of the companies that are winning, tech companies, more speculative companies, companies that are highly shorted, those are the things that win coming out of a recession. Those are things that win when the economy is getting a reprieve. So the market is really giving you a very consistent read on this.
Samir, you seem to have a different take here. Your base case is for a growing probability of a moderate recession before the end of the year, extending into 2023. You're also looking at the potential for the Fed to hike 75 basis points in September. So, how do you kind of look at what Jonathan's saying with regard to the backdrop you're looking at?
Longer term, if the Fed does get inflation under control, it's probably a positive for both fixed income and equity markets. And it's no surprise then that rates have come down on the long end and growth stocks have led the way. But, look, you've come a long ways in the past 6 or so weeks, right? If we were having this discussion at 36.50, completely different discussion, right? At that point, you're a contrarian. You're talking about a Fed pivot. You're talking about a softer landing. You're clearly, out in the kind of boonies by yourselves. Now, it's pretty much the consensus trade, right, is that, the Fed's got to figure it out. Inflation will come down. And, we're right back to all the memes, SPAC, crypto, trades working again. So at this point, I think the contrarian trade, much like the one from mid-June, was, is to fade this. And again, that's not to say that we don't see upside to our 2023 target. We've got a $4,400, target on the S&P for the end of 23. But from here, I would say that probably the next 10%, it's much more likely that it's down than up.